Well, technology's been very strong. We've had a disruption in the marketplace, beginning with the COVID last year, and we see the big players that have benefited, last year in 2020 with many of the largest caps benefiting. But we're now seeing smaller companies perform well. Last week, our small caps are up 11%, driven by a couple of tech. But we're also seeing a lot of strength in international stocks, particularly in China, where Hong Kong has really benefited. And actually 7 out of our 10 top picks are based over in Hong Kong. So we're seeing technology, but healthcare, particularly small cap and genomics, very strong in the last probably 6 months, 9 months.
Can we expect that capitalization story to continue? And by that, I mean that small cap stocks and mid cap stocks continue to have the relative momentum edge over those large cap stocks that performed so well last year. I look at the Russell 2000 small caps over the last 3 months, and it's even blowing away some measures that we tend to watch all the time as bullish, like the NASDAQ.
Yeah, you're right. In fact, we're up 20% year to date in small caps, 21% global. We've got to remember the small caps have been outperformed by large caps over the last 5 years. Large caps have outperformed small caps by 60%. So 60%. So if we only focus the last 3 months, we've got to remember this story goes much further back. Small caps have a lot of room to catch up. They had a tough year early on last year, but they caught up, as you mentioned, the last 3 months. We see it last week. They had a very strong period. We see this running for a long period of time. So we see 2 areas of strength: small cap U.S., international, particularly Asia, from a global standpoint.
Now, you mentioned that Asian story, the international story as well. We're hearing a lot more chatter from investors, investment professionals, strategists that say that there is better value to be found outside the U.S. Is that your case right now? And if so, where do investors go for that?
Yeah, so 100% the valuations are better. We've got to remember that mainland China now is going into Hong Kong. There's a 36% premium in mainland China. U.S. investors, in fact, 40 billion of the 60 billion year to date is going into international, primarily Asian markets in China. The PEs in Hong Kong are 12 to 14. In U.S., it's 23. So there's a 50% reduction going from U.S. to Hong Kong. If you look at tech is 68 PE. So appreciably lower discounts. And we've also got to remember that with regulatory issues now allowing money to flow easily from mainland China, also from the U.S. going into, there's encouragement because the ADRs have been beat up a little bit because there's concern about securities being delisted off the major exchanges. So investors are now going directly into the markets. So we see Hong Kong being a great place. There are companies like eHang up over 250% year to date. Futu, fintech company, which is benefiting. One of the strongest growth stories in the world. We track 55,000 companies. This one is top 20 in the world. Multiples of returns in terms of revenues going up 5-6 times in the last 3 years. So we see great growth stories here. And last week, of course, we saw an IPO pop 300% the first day, biggest IPO ever in Hong Kong.
Shepard Smith here. Thanks for watching CNBC on YouTube.